With a week to go until a possible no-confidence vote in the House of Commons over Boris Johnson's government, Jeremy Corbyn, the Labour leader who would call any confidence motion, is now tweeting that he'll do everything he can to stop this bankers' Brexit. And as we get nearer the Brexit deadline, the gilt markets are becoming more attractive. Or is this just a global phenomenon of the debt markets in this current part of the cycle? Simon French is chief economist at Panmure Gordon. He joins us now. Simon, welcome.
Thank you, Jeremy.
Going with the Brexit point first of all, is the 31st of October deadline a dead cert now? Are we to expect us an automatic exit from the European Union on that day, or is there still more to come, do you think?
Oh, there's still plenty more acts in this drama. Look, there's probably two to be focusing in on. The first is whether a vote of confidence in the UK government can be successfully passed by the opposition parties. And if that happens, then that ticks off the second event, which is whether in the 14 days that follow a no-confidence vote, a cross-party government will be brought together in order to ask for an extension beyond the 31st of October, or whether we're staring at elections in October. I think either route will actually take you to a potential extension, and therefore this is why that is not a certain deadline for investors to factor in.
And that extension driven from the European Union side? Are they keen to get an extension because of the political upheaval here in the UK? Or is it going to be the UK that will ultimately go for the extension?
It'll be the UK. The UK is the only one that can request it. The EU is the only one that can acquiesce to it. The EU have said that if there is a quote-unquote democratic event, for which read either a general election or a second referendum or some sort of reconstitution of the existing parliament, a government of national unity, then that itself would allow the EU leaders to say, OK, we will grant another extension, despite many EU leaders, including most vocably Emmanuel Macron, having said, no, this is a drop-dead deadline.
Yeah. Let's bring up a chart of sterling against the US dollar. This is one of these charts. It's difficult to know whether we follow sterling against the US dollar or against the euro. Here, against the US dollar, we've seen a little bit of an uptick on the far right-hand side of the chart. This is a daily chart here. Of course, there's two sides to every currency story. Here it's US dollar, sterling. What are we pricing in at these levels at 122? Are we at these levels around the 120 looking for a no-deal Brexit, or is that a far worse situation for sterling?
The latter. So our base case is that a no deal, no transition Brexit on the 31st of October, should that go ahead, you'll see sterling testing the low 110s in that scenario. So certainly a 122 against the US dollar. The market is not pricing in the full likelihood of a no deal Brexit. It's still putting a likelihood function on those events that we spoke about just previously, a potential second referendum, a general election, a cross-government party coming together and delaying that moment, or indeed bringing back the withdrawal deal again. So there's still that being priced into FX markets right now.
Moving into your space of the economy, we've seen that negative print of Q2 GDP. Whatever happens, are you expecting Q3 to be negative in any event, or do you think there's still an opportunity here to make a narrow escape from a no-deal Brexit and see the economy pick up, or is it all now too late? Are we definitely going to head for recession?
Definitely not, actually. I expect Q3 growth to be positive in the UK. A couple of timing issues here. So you'll have this pickup of stockpiling again as firms again get marched up the hill preparing for a departure from the EU. And as that boosted Q1 growth by 0.5% in the UK, you'll see that secondary pickup in Q3. You also have the things that held back Q2 output, which was the timing of the shutdown in car production plants being brought forward. That activity will now be brought into a period, Q3, where normally they are having their shutdowns. That, combined with fairly steady employment growth still in the UK economy, means that we would expect 0.2 to 0.3% growth. And I certainly don't see a technical recession taking place. Q4 is the much more concerning scenario if you're worried about a no deal.
OK, so in that case, for that sort of argument, you're going to get the Brexiteers saying, I told you so, we're in a better position than Europe. Germany's looking like it could go into recession. I don't know whether or not you agree with that situation, but certainly many are saying with the EFO readings, the ZEW readings, the negative reading we've already had in Q2, Germany's looking in a far worse situation than the UK. That surely gives arms to the Brexiteers to say, yes, hang on a minute, we are in a good position.
Absolutely. I mean, if you're economically illiterate, that would be your interpretation. Unfortunately, comparing G7 economies with each other is comparing apples with pears. You have to look at the underlying trend growth rate. You have to look at the specific nature of the German slowdown, which is quite specific to their automobile manufacturing sector. You actually look at their services sector, it's performing very strongly. PMI is around 52, 53, so steady growth, whereas the UK services sector, 80% of the economy, at 50, flatlining. So you need to be much more nuanced. And unfortunately, nuance doesn't generate headlines, but it's the right way to analyse what is actually going on. But also, and this is the most important part of Brexit, the time to analyse whether Brexit has been a success or a failure, whether it has created economic damage, is over the period of 5 or 10 years. It's not over 5 or 10 months or weeks. That is unfortunately the timeline by which you make the assessment on what have been the frictions to trade, the overall economic damage.
Just want to pick up on one other point I mentioned at the top, and that's the gilt yield curve. Gilt markets are looking very attractive. We've seen the yield drop, I think 0.9, I think it was in July. Now here we are at 0.55 for the 10-year part of the curve. What does that indicate to you? Again, going back to the comparisons to some of the Eurozone economies, that is in a slightly better position.
Yeah, it's a positive nominal yield, although in real terms, when you take into account inflation, actually the real terms yield is probably on a par with what you're seeing with German bunds, so factor that one in. Also, at the moment, what is going on in the gilt market is just effectively a sympathy trade with what's going on with treasuries, bunds, JGBs around the world. At the moment, you haven't seen any Brexit-specific factors that might indeed start to push up the yield as investors start to price in potentially that lower sterling, pushing up inflation and therefore requiring a higher nominal coupon. At the moment, we haven't seen that. We haven't seen the decoupling. But look at what happened with Italian BTPs and bunds and that spread blowing out when you had political uncertainty. You potentially get that in the third and the fourth quarter in the UK.
Okay, let's just bring all this together and ask you what you're recommending and your colleagues are recommending clients do in the market at the moment, from Panmure Gordon's point to clients. What is the message that you're sending out?
Well, I think it's very, very clear that UK assets are undervalued versus A, their long-term average, and B, their international comparators. So there is a significant, we estimate about 20 to 25% discount on UK assets at the moment. Now that is, I wouldn't say unprecedented, but you probably have to go back to about 1989, 1990 since you saw that divergence between equity markets, a developed equity market like the UK and other global equity markets. So there's the opportunity. Then you have to say as an investor, on what time horizon am I investing? I think things could get politically much more difficult and therefore that discount could widen. Therefore, if you're on a short horizon, short-term trading, I'd be very cautious. But if you're taking a much longer-term, deep value argument, then eventually you and I will stop talking about Brexit and we'll move on to other stuff, thank God. And when that happens, that discount will unwind and there is the opportunity for long-term investors.
And what sort of investments are you talking about there? Are you talking about blue chips because they're sensitive to sterling, which is lower, which gives them an advantage? You're talking about mid caps, or are you talking about some of the smaller caps, or is it a general?
It's a great question actually, because initially one assumes that it's just the domestic basket that has been sold down, but actually if you look at the international earners that have performed better, they're still rated about 12 times next year's earnings, which historically the UK market's about 14, 15 times earnings. So there's still a discount in there because a lot of people are playing geo-macro in terms of their asset exposures. They're effectively saying we're just going underweight the UK. It doesn't matter whether it's an international firm or a domestic firm. So I'd say it's quite potential for quite a broad-based rebound, but if you want your high beta rebound, there is a slightly larger domestic discount in there. So yes, your house builders, your domestic banks are probably going to be the biggest rally in the event that we get some clarity and we get the movement forward in what has been a very stagnant and disappointing political backdrop.
Yeah, interesting. Simon, we'll leave it there. Thanks indeed for joining us. Simon French, the chief economist at Panmure Gordon, with his view on how things look for some 8 or 9 weeks until that 31st of October deadline.